The second quarter of 2024 was marked by significant uncertainty. Central banks were in the spotlight, with investors closely watching for hints of interest rate cuts. Equity market gains at quarter end were increasingly dependent on a small number of large-cap technology companies, signaling potential market weakness. I'm Mark Kinney, Chief Investment Officer with Newport Private Wealth, with your second quarter review and outlook for Q3. This year has underscored the complexities of managing through an economy in transition. Despite the turbulent backdrop, Newport's investment strategies in the quarter continued to deliver results. At the halfway mark of 2024, our 5 mandates performed within their target ranges, consistent with our one-year trailing results. Our mandates are intentionally designed with a diverse mix of 12 public and private asset classes, allowing us to deliver these returns without taking unnecessary investment risks. We strategically allocated $85 million in new investments, bringing our total year-to-date to nearly $200 million. These decisions reflect our commitment to maintaining a balanced portfolio that can weather market fluctuations while seeking growth opportunities across private and public markets. We identified potential capital gains in the bond market, key opportunities in private senior secured debt, and high-income Canadian equities. Let's review these investments, starting with bonds. Bond markets reacted to shifting interest rate expectations, with the FTSE Canada Universe Bond Index falling 2.13% in April, followed by gains of 1.43% in May and 1.13% in June. These fluctuations highlighted the sensitivity of fixed income markets to monetary policy. They also presented opportunities. We made additional allocations to bonds, bringing our total investments to nearly $27 million for 2024 and over $120 million over the past 12 months. Initially driven by higher interest rates, we are also keen to position ourselves advantageously ahead of future rate cuts. A key differentiator for Newport's investment platform is our 20-plus years of success in diversifying yield investments through alternative assets. These include private debt, private real estate, mortgages, and infrastructure. They provide consistent income and offer protection against market volatility. In the quarter, we allocated $25 million to a Toronto-based private debt manager, marking our third investment with this firm. The manager has a strong track record in junior debt and equity investing and will focus on providing unitranche loans to private businesses. These loans, which blend senior and subordinated debt, offer an attractive risk-adjusted return profile. Our private real estate investments make up 10 to 12% of client portfolios, totaling roughly $500 million. We're focused on income-generating apartments with value-add potential, prioritizing stable returns over taking on development risk for growth. These investments are managed by independent specialists with targeted strategies. In Q2, the specialists leveraged market weakness to acquire high-quality properties at significant discounts. This strategic move positions us well for future growth. We've capitalized on the growing demand for premium rentals by investing in a 3-property portfolio with one of our long-standing managers. These new or recently built properties in Texas, Georgia, and Florida offer strong income potential, especially in markets with high barriers to home ownership. It's important to note that Newport does not have any meaningful exposure to retail or office real estate. We anticipate that both sectors will continue to face considerable pressure. This is due to a combination of structural shifts in these sectors and elevated interest rates, especially in the U.S. In public equities, continued high interest rates in the U.S. led to a market drop, with the Dow and S&P 500 both falling over 4% in April. Markets bounced back in May as new data showed a slowdown in both the labor market and consumer spending, signaling rate cuts were on the way. It would be easy to conclude that the whole market was moving upward, when in fact it was mostly driven by a few large tech stocks. Earnings expectations for the mega cap companies have yet to justify their current valuations, which further complicates the outlook. This trend poses a unique challenge for investors as it fuels speculation about the sustainability of such market conditions. Newport does not adopt a speculative approach, but rather uses market instability to our advantage. We opportunistically increased our public equity exposure by $53 million, bringing our total for the year to $107 million. Since the market bottomed in October 2023, we've deployed $180 million, aligning with our strategy of gradually adding capital outside of extreme market volatility. These opportunities arose from the performance gap between megacap stocks and the broader market. Newport's portfolio is diversified not only by asset class, but also geographically, which provides protection against currency fluctuations, particularly the Canadian dollar's weakness. The Bank of Canada made a significant move in June by cutting its key interest rate from 5% to 4.75%, its first reduction since March 2020. This was followed by a second rate cut in July, potentially signaling that further cuts could be possible if inflation continues to decrease. As interest rates decline, holding large cash balances as a long-term strategy becomes questionable. Cash earns less in a declining rate environment, and interest income is taxed less favorably than dividends and capital gains. Within Newport's proprietary mandates, cash levels are currently around 8%, providing a cushion without sacrificing the potential for growth. With the path to further interest rate cuts clearer, we are putting more cash to work. At the midway mark for the third quarter, it's hard to predict how it will end. As we enter August and September, historically the worst 2 months for the market, we are prepared for continued volatility. The U.S. Federal Reserve chose to hold rates steady in July, following its earlier decision to stay the course in the second quarter. Market expectations now lean toward a rate cut in September. If this doesn't occur, it's likely that any rate cuts will be delayed until after the November elections or possibly into early 2025. A strong start to the year and robust stock market performance in July led to the belief that the entire market was moving upward. Once again, it was only a specific subset of stocks driving this momentum. The resulting market pullback, concerns about a U.S. recession, geopolitical tensions, and political uncertainty can weigh heavily on risk assets. We should expect some further fluctuations over the next 6 weeks. Given these conditions, our focus remains on the long-term management of your investments. The economies in the U.S. and Canada appear relatively strong, with few indications of a significant slowdown. Consumers remain resilient, housing is in short supply, and economic conditions are stable despite what the financial media might report. Careful deployment of your capital is the best way to preserve it and to achieve attractive returns at reasonable risk. As we look forward, our attention remains firmly on helping you achieve your long-term goals while managing the challenges presented by the current landscape. Newport's investment committee continues to make decisions grounded in our core principles: maintaining diversification, exercising prudent risk management, and seizing opportunities as they present themselves. Our primary focus is on preserving wealth and generating consistent returns over the long term. Thank you for your trust and confidence in Newport Private Wealth. Enjoy the rest of the summer and know that we're here to support your financial goals every step of the way.